case of individuals, how is the jurisdiction of tax handled within the EU when the border can be crossed at any time? Now, there's a lot to be said on this. For this session, I'm going to share the key principles, and you're welcome to go and look at all the detailed notes we provide on this. Firstly, you've got to go and look at, the domestic laws of each EU country, which are generally based on the number of days spent in a country. And they also have got the 183 days rule. You've got to look at where is the person, and does the person have a permanent home in that country? In other words, where the individual's personal and economic interests are centered. And then you've got the so-called center of vital interest, which considers where the individual has stronger personal and economic connections. So that's your tax residency rules. Then you have tax domicile rules. And there you've got to look at where an individual is permanently settled and intends to remain, even if they spend significant time in other EU countries. So one must go and look at that. And then you go and look at another thing which is quite important, is the double taxation agreements. And DTAs often resolve issues such as which country has a primary taxing right, and that's many times determined where the income is earned. Specifically, if we look at the EU, tax credits or exemptions to avoid double taxation in both countries must also be looked at carefully in the DTAs. And then you have cross-border workers. And that is many times the individuals who work in one country and live in another. They are commonly known as cross-border workers and are usually taxed on the employment income in the country where they work and on their worldwide or their other income, as an example, investment income, in the country where they reside. And then you'll have special bilateral agreements between the jurisdictions. Now, there's a lot of other specific principles which relate to remote work, temporary relocations, and foreign sourced income. And one must go and look at each of the scenarios. And I would highly recommend, if you are uncertain or a client is uncertain, seek proper advice in the jurisdiction where it is, to make sure that you do not make a mistake, because you're dealing with people's livelihoods here, and tax amount in both countries would be very bad, especially if you don't have the benefit of double taxation agreements or the credit in the one against the other one. Now, there are EU directives affecting cross-border taxation. You have the Parent Subsidy Directive, the Interest and Royalties Directive, and the Savings Directive. And one needs to go and look at also how these rules affect you and how the harmonization impact of this works specifically. One other thing I might just add is that you've got certain exit taxes and immigration rules which are also applicable, and one needs to appreciate also how that plays in, and if that does have any negative impact on the case in hand. I'm going to stop at that junction in terms of that question. There's a lot to be said on that, because the EU is a large, it's quite a few number of countries, and there's very specific rules applicable due to the fact that the EU, let's say employees in general and businesses do operate over various jurisdictions.